Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about Himadri Specialty Chemicals. Is the story over in the stock or we need to invest at these abysmal levels? So let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position into any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Before I talk about Himadri Specialty Chemicals, here's a small request that kindly support me on Patreon, and once you do that, it will help me grow the channel, help you also ask me questions in greater detail. Once you get the $10 membership, you'll have access to my portfolio, my watch list, and number of podcasts that I put up from time to time. And if you can pay directly $100, then you get 12 months access by paying for 10 months, so that's a 25% discount if you pay directly $100 for the whole of the year. For detailed market or company talk, you can directly email me and we can work things out. Now, what the company established in established in 1990, it is the only fully integrated carbon chemical plant company. Their different products include carbon black, coal tar pitch, corrosion protection, specialty oils, etc. They have usage in industries such as tires, defense, electronics, pipes, etc. And they also make specialty chemicals or chemicals for lithium-ion batteries. And this is where the stock really got the prominence in 2016-17. And in that earlier mid-cap bull run between 2015 to 17, this one really surged high. If you look at the financials, and these are December numbers, so sales went up by around 6-7%, 467 crores versus 430, but profit was flat, and the numbers were flat, and this is why the stock is not moving anywhere, because there are no you can say significant improvement on the bottom line that we are seeing, and there has been an increase in debt, and probably that is the reason why, although the sales went up and really they worked on their margins, etc., yet because of interest cost, probably the bottom line has not improved, and that doesn't go well with the investors, because there are many companies in a number of sectors, even in sectors which are so renowned to be defensive, where the companies have produced 20, 30, 40% year on year growth, even more 70 to 80% growth, whether you look at diagnostics, pharmaceuticals, or different sort of IT companies, mid cap or large cap. So there lies the problem, that the profit growth is not coming through, although return on equity of 20% and operating profit margin of 18% is not that bad for the industry. So overall it's good, but if you look at even in their industry, in the chemical industry, the numbers have remained pretty stable, the numbers have remained pretty robust. So what one needs to understand is probably they need to people need to understand that investors, and currently in this kind of an environment, when the small cap index is at a new high, mid cap index is at a new high, they are looking for high growth stocks so that more growth comes through. So there is a heavy competition in terms of which companies are gaining traction in terms of growth, and that's where Himadri is lagging behind. So if you look at the stock performance, did exceptionally well in 2017. So as I explained, between 15 to 17, the stock went up 4, 5, 6x, and that's where the re-rating happened. But since then, it has been going down. It was the EV push that really taken the stock higher, because they were making the raw materials for lithium-ion batteries, and if electric vehicles really had come in, say in a year and a half from the time people were talking about it, things would have been different for Himadri. But right now everything is on the back burner. We are seeing, because of pandemic, what is happening, and that is why I am not a huge fan of getting into stocks which are more or less you can say concept based, that okay, when EV will come in, the stock will do well, when renewable energy will be big, then renewable stocks will do even better, and all that. What goes on is that it takes a lot of time, and that is where the problem begins. So you need to be slightly in the present, don't look beyond say 3 to 4 years. And in 2017 it looked like that by 2019 or 2020, EV is not or electric vehicles are not going to be running all over the place here in India. So that is the main issue. The second is China emission bans was a big positive for the company, but now it has gone through a lot of time, and a lot of smaller companies have done really well. You look at a Naveen Fluorine has become huge. You look at alkyl amines. You look at some other specialty chemical companies that are doing extremely well in other domains, which were very small, say 5 years back. So over the last 5 years, these stocks have, or these companies have overtaken something like a Himadri or companies that are into the EV space. And that's where you need to understand that companies in the same sector can do different things, and that's why I have always remained stock specific, company specific. It was a 6x at its peak at 197 in January of 2008. So from 33, 32, 33, it went to nearly 200, and now has been languishing. So currently, yes, it is trading at you can say 8 times the FY20 EPS that come in, and probably around only 9 or 10 times FY20 EPS. So 21 EPS. So it's not expensive at all, but there is a reason for the company for being not expensive. And another learning from this is that you need to understand that some companies are expensive and they just keep on becoming expensive because the numbers and everything looks good for the next 2 3 years, foreseeable next 2 3 years, and that's why that gets re-rated, whereas other companies even with decent numbers do not get re-rated because next 3 years they might not be producing, you can say, astronomical growth. So there lies the problem with Himadri. So in trouble with current health situation, not doing that well, many plants are closed, and you need to understand that some businesses are doing very well because they are essential businesses, other businesses are shut down because they are not into that. Now Himadri is also into auto ancillary and auto things and all, and we have seen what happened with it during April and June of last year. So things are not that great overall for the company to do well in this kind of an environment. You have to take note of that. So stock is down 70% from the peak. It has gone up a little bit, but it has been consolidating between 30 and 50, and we are seeing that time and again. So it has been a consolidation from a long period of time, and I believe that this will only get rectified once things improve on the numbers front. Only then it can break these levels. So why there has been a massive fall? All autos under stress. So this is majorly an auto ancillary company providing chemicals in that sector. Plus it provides chemicals in other kind of industries, but it was into lithium ion, etc., and batteries and producing EV. Now if auto industry would have been revived and would have been doing well, then the company would have done extremely well. Then if things would have opened up, simply put, if things would have been the same as 2017 and 18, and we wouldn't have been in this raging pandemic, this stock would have done much better than what it is doing today. So it's a clear cut opening up trade. Once EV space picks up, yes, Himadri will do well, but it's going to take time. I think it's going to take at least 3 years from now for this company to produce the results that everyone who is invested into it aspires. Yes, valuations are attractive, so I'm not saying that if somebody is invested for a 5 year period can sell here, because valuations are very attractive and the move can happen any day. But at this time, at this point of time, the future demand looks bleak and the economy is shrinking. So you have to take into account that economy needs to go at 6-7% for these kind of companies to really do well into the industries that they serve. So in that regard, we need to wait at least a couple of years, hopefully from FY24 onwards. That's from 23 February March. Things could look much better, but at least for the next 18 months it looks difficult. That doesn't mean, I again say, that the stock will completely crash from here. It has been already plummeted down. So one needs to be careful while analyzing the future. You need to look at where the stock lies. It's not at 200, it's closer to 40-50 rupees. So there lies the opportunity. Maybe if somebody can wait 5-6 years, hope this could be still end up being a multi-bagger. But at this point of time, with the kind of news flow that we are in, it looks difficult. So apart from these points, it is a direct play on defense with orders from DRDO. They might be delayed as well. So there is a defensive play to it, that they get orders from DRDO, etc. But again, all these things will happen once we are out of this pandemic. That's when the government would have their, you can say, focus on defense, on increasing the defense things, budget, etc., on moving things and getting the economy chug along and all. It will be very difficult at this point of time. We are having localized lockdowns, then opening up, then maybe another lockdown, maybe a third wave and all that. So I hope you understand that it is a direct consumption working out in, so you have to understand that consumption right now we are, see, only direct consumption will work out at 3-4%. That's what I meant. So at this point of time, it will be very difficult for these kind of companies to really perform. Companies which are directly related to public consumption, companies which are related to food products, making of food products, which are into, you can say, home improvement products, because people are working from home, all these companies may end up doing much better than companies which are into auto ancillary, batteries, etc., and so on and so forth, or into the old economy space. So that is why the fall has taken place, because most of the larger investors are not looking into such stocks at the moment. So what needs to be done? If you don't have it, probably avoid it completely. Let it double even. Let the stock go up even more from here, maybe even double from here. But you need to see visibility for the next 3 years. First, the next immediate 3 years, and only then buy into the stock. If you have it, then hold with a stop loss of around 39.40. Just hold. I don't see the stock fall a lot. It has already fallen a lot. So if whenever the things improve, there could be some corporate announcement, there could be some rejig in the business, etc., and the top management, etc., something can happen and the stock can easily go to 80 to 100 rupees. There is no two ways about it. The valuations are good, but it doesn't look like that the performance of the business will be much better in the next 1 year or so. So avoid most of such small caps, avoid such kind of a stock, but you have it, hold on to the stock. So this was a video on Himadri specialty chemicals. Please like and subscribe my channel, hit the bell icon so you can get my videos straight away when I post it. Thanks a lot for watching.